Hi, this is Steven Aniston from VIX Contango, and this is the second part of our introductory videos. In this video we're going to discuss in more detail how to time the market using volatility and how to trade volatility ETFs for profit. In this video we're going to discuss the VIX cycle, the VIX futures curve, its extension the volatility curve, and an assortment of volatility signals. Let's start with the VIX cycle. As the market goes up during a bull market, at some point it gets to a point where there is a sell-off. During the first part of the sell-off, investors who have not been hedged, who have been riding the bull market all along, at some point realize that there's a sell-off underfoot and they start to panic and buy puts. And there is a massive VIX spike in the very beginning. Then, as the sell-off progresses and kind of reaches the first stages of its exhaustion, the VIX starts to lay off. It's still elevated, but it starts to lay off. At that point, people have hedged already, and they don't feel like they need to hedge anymore, or at least not as much as they did in the beginning. Then, as the market kind of recovers, investors pull the plug on hedging and the VIX drops quite dramatically. So the first phase is a spike, the second phase is an aftershock, and then the third phase is a decay. Then as the drawdown goes down again, resumes its downtrend, and sometimes it may overshoot and go to the downside or stop, there is a secondary spike in the VIX. People again rush to protect, but this rush is not as big as the original rush. Usually it retraces back up to about 50% of what the original spike was. Then there is a little bit of an aftershock. Again, people start to lay off as the drawdown comes to an end and price finds support. And then as the market starts to recover, decay phase ensues. And then as the market continues to go up and continues to grind up slowly, we enter a phase of a long decay in the VIX, which sometimes can last many months. So whether on a shorter time scale or on a longer time scale, the VIX cycle is a spike, aftershock, and a decay. What are the reasons for the VIX cycle? There are many reasons, but the primary reason is that hedging costs money. Buying put options to protect portfolios costs money, and managers are very loath to pay that cost because it affects their performance numbers, and people will always want to beat the market, they always want to do well, so they try to minimize their hedging costs as much as possible. As such, investors really don't hedge until there's a really good reason to. So that is the primary reason why investors always kind of rush to hedge in panic. But the other reason is that the market tends to go up over the long run. As we discussed in a previous video, the market is up 80% of the time. The market tends to climb walls of worries. It tends to climb uncertainty and global uncertainty and geopolitical events. So it's very difficult to figure out when exactly to hedge, and professional investors know that, and that's why they really need to get evidence before they hedge. And not to mention, governments around the world try to suppress volatility, so they enact measures which then further dampen volatility. That's why the VIX cycle tends to be there is a big spike in the very beginning when something that people weren't expecting happens, and then as the situation gets under control, the VIX tends to go down. This has been happening for over 20 years, so there's no reason to think why this would change anytime soon. Let's talk about the VIX futures curve. The VIX futures curve is from the VIX futures market, where investors place bets on what they think the VIX will be in the future. Normally there are about 8 contracts in the VIX futures market, from the front month contract, the nearest month, all the way out to 8 months out. And this gives us an additional information as to what investors think the VIX will be in the future. Now, this curve comes with a little caveat. The VIX futures market is not priced the same way that the oil market is priced, or some other commodity futures contracts are priced, simply because the VIX itself is not the same type of commodity. In the oil world, you have cost of storage. People have expectations about the price based on supply and demand. That's really what gives shape to the oil futures curve. The VIX futures curve is driven by a different set of reasons, by a different calculation. The main reason for the VIX futures curve to look the way it does is that the VIX is meant to be a mean reverting instrument. In other words, it's always supposed to oscillate around the mean. So if the VIX is priced very low in 14, over time VIX futures players will assume that the VIX will revert back to the mean. Ideally, in a long term, it will get to the mean. Now, what is the VIX mean? Historically, we calculate the VIX mean every day. It's about 19.83 right now, but it has generally hovered in that 19.8 to 20 range. So, as a general rule of thumb, people use the number 20, to make it easy. So, if the VIX is above 80, if the VIX is above 20, the market is under duress, and if the VIX is below 20, the market is good because the VIX is below the mean. But in any case, the VIX futures curves always the 7 and 8 month futures try to approximate the long-term average of the VIX. As a result, the VIX futures curve has two primary looks. The first look is called a contango look. A contango is a term used in the futures market, which describes a condition where the second month future trades at the premium of the first month future. So the back month, the second month is higher than the first month. There's another term also used in the futures market called backwardation that describes a condition when the front month future, the first month future, is higher than the second month future, so it trades at a premium. That is called backwardation. The VIX futures curve, the distribution of the VIX futures curve in terms of contango, how often it is in contango, is highly skewed. 85% of the time the VIX futures curve is in contango. So if you look at the zero number, this is right here, right? And if you look, most of the values tend to be positive. So there is a heavy skewness here that we can probably take advantage of. And the question is, why is the VIX futures curve in contango so often? Now, the first reason is the VIX futures market was created in 2004. So since 2004, most of the time we have been in a bull market. We've had a bull market from 2004 and 2007, and then we've had a bull market from 2009 till today, 2016. We had a very brief but sharp bear market in 2008, 2007 and 2008. So throughout that period of time, we have been in a bull market, so the VIX has generally been suppressed, and therefore the VIX futures curve has been in contango. So again, if you look at the VIX distribution itself, as you can see, it's heavily skewed towards the lower numbers. This is the VIX of 20. This is the VIX average right here. As you can see, 85% of the numbers are lower than the average, and a very small amount is higher than the average. Since 1990, the VIX distribution kind of still looks the same. However, the VIX is below the average, below 20, only about 60% of the time. But the general point is that the VIX futures curve is in contango majority of the time, and that is something to keep in mind as you trade the market and as you trade the VIX. Now, let's talk about the importance of backwardation, or let's talk about what the VIX future curve actually means in reality. When the VIX futures curve is upward sloping, what that means is that people assume that the VIX will revert to the mean, and therefore the VIX will increase in the future. That doesn't mean necessarily that people think that the market is going to collapse 8 months out. It just means that the VIX futures players assume that the VIX will revert to the mean. And as we said, 85% of the time that actually does not happen. So what is more important, the more important part of the VIX futures curve is the front portion of the VIX futures curve, because it trades near the spot VIX itself. So what information can we get there? If you look at the VIX1 and the VIX2, the front one and the back month contract, if we have a drawdown, and that drawdown is proceeding, at some point the VIX starts to spike up, and at some point it spikes up quite a bit in the beginning part of the VIX cycle during the spike. At some point the VIX1 and the VIX2 go from a contango formation into a backwardation. In other words, the VIX2 starts to trade below the VIX1. Let's think about this for a second. When the VIX2 trades below the VIX1, what the VIX futures curve is telling us, what the market players trading in the VIX futures market tell us, is that they're not worried about volatility in the future as much as they are worried about it today. So they really panic right now, but going a month out, they're not really worried so much. They're not willing to assign VIX a higher premium. So what that means is that people are no longer worried that the market is going to go down. They're not willing to spend money on hedging into the future anymore. And that is usually a point where the market starts to find a bottom and recover. That is a really good indicator to time the market and to determine when the sell-off that we're currently in has ended. And as a matter of fact, 38% of the time, SPX drawdowns end after 1 day. So after 1 day, SPX drawdowns end 38% of the time. After 2 days, they end 60% of the time they end after 2 days, 68% of the time they end after 3 days, 77% of the time they end after 5 days, 88% of the time they end after 10 trading days. So what we're saying here is that the moment the VIX futures curves go into a backwardation, the SPX drawdown will end 75% of the time. It will end within a week. This is very good knowledge to have, and actually almost 90% of the time it will end after 2 weeks. So the moment we enter into backwardation, you need to start watching this, and you need to start deploying money, start buying the SPX, start buying the dip, and start shortening volatility, going long the XAV. So as important as backwardation is to time the market, contango, it is just important to be aware that the VIX futures curve is in contango in order to ride the wave up. When the VIX futures go into backwardation, then it immediately will go back into contango, and then it can stay in contango for many months. And usually the market is melting up during that time. The SPX is going up, and XAV is also making pretty good money, the short volatility ETF. So it is important to be aware when contango is positive, and not only positive but also rising and is holding above some key levels. Contango also is very important for the volatility ETFs, simply because they are made out of VIX1 and VIX2 futures. As we discussed the XAV and the VXX in a previous introductory video, they hold a mixture of VX1 and VX2 futures, and they will sell a little bit of the VX1 future, and they will buy a little bit of the VX2, and the XAV, the short volatility ETF, would short the VX2 future, and then it will cover it, will buy back, buy back the VX1 future. And so long as the VIX futures curve is in contango, the short volatility ETF will automatically make a little bit of money every day, and the VXX, the long volatility ETF, will lose a little bit of money every day. So the contango is a very, very important indicator for the volatility ETFs simply because it's a big determinant of their behavior in the near term. So to summarize, Contango is good for the XAV and backwardation is good for the VXX. Also, Contango is good for the SPY and backwardation is bad for the SPY. So that's kind of a simple way to think of it. However, the Contango and backwardation is not a foolproof indicator. It only represents information coming out of the VIX futures market, right, which is a $40 billion market. And it is not the whole story. We never want to limit the information that we take in. And we really need to, if we look at this picture here, we need to remember that the bigger market is the SPX options market, which is at $170 billion traded daily. And that is where the VIX, the VXXT, the VXV, and the VVIX are calculated. So we shouldn't just be looking at the VIX futures, we should also look at the spot VIX indices as well. And that's why I created the volatility curve, which is an enhancement to the VIX futures curve, and plots the VIX spot indices alongside the VIX futures contracts. And the VIX spot indices are in red dots here. This is the VXXT, the VIX, the VXV, and the VXMT. This is and they're ordered by their time to expiration, by the length of their term. So for example, the VXXT is a 9-day volatility index. It's in the very beginning. The VIX is a 30-day volatility index. The VX1 is the front month future and represents the VIX within the next month. So it represents data from between 30 to 60 days. VX2 is from 30 to 90 days. VXV is the 90-day spot index. VX3 is from 90 to 120 days. VX4 is from 120 to 150 days, and so forth. So they're ordered by the time left to expiration. The volatility curve is very important, and that's why I have created a suite of indicators to measure different phases of the volatility curve. Some of these are commonly accepted, some of these are of our own creation. In any case, if you follow our site, you need to be familiar with these definitions and stick to these definitions. The first one is the V delta. This is the difference between the VIX and the VXXT, the short-term volatility ETF and the 30-day volatility ETF. This is a short-term structure indicator, and it's entirely calculated out of the spot market. Row yield is the difference between VX1 and it's the premium of VX1 over the VIX, and it's a measure that combines the spot market and the futures market. This is the row yield here between VX1 and the VIX. The interesting thing about the row yield is as the VX1 future gets closer to expiration, the VX1 future must match the VIX at the day of expiration. So the row yield will always collapse to zero, whether from a negative value or from a positive value, will always collapse towards zero as the VX1 future expires in the middle, at the third week of the month. So this is the row yield. Then we have Contango, which is entirely calculated out of the futures market. And when the Contango is negative, we're in backwardation. Where Contango is positive, we're in a Contango formation. This is the Contango is also a premium, is expressed as a percentage. Then we have the Contango row, which is the difference between the VX2 contract, the backbone contract, and the VIX, the spot VIX. This combines again spot and futures markets, information from both markets. And this is the Contango row. It's usually a bigger percentage when the VIX curve looks like this. And it's very important to track because as the VX1 travels towards VIX and the row yield collapses, if the VX2 future is usually pretty unwieldy and stays high where it is, so the Contango row eventually turns into Contango as we get closer to the expiration. So if the Contango row is very positive, and let's say it's 10% and Contango is 5%, as the VIX1 future travels towards expiration in the last couple of weeks before expiration, the Contango is going to go from 5 to 10%. So you can kind of tell where Contango will go by monitoring the contango row. And the final indicator is the V ratio, which is the difference between the VXV, the 90-day or 3-month volatility index, and the VIX, the 1-month or 30-day volatility index. This is the V ratio. It's calculated entirely out of the spot market, and it's one of the best indicators that tells you that trouble is over. When the V ratio goes above 1, when the VXV trades higher than the VIX, this is a good indication that the market drawdown has ended. Let's discuss the volatility curve in more detail. I have looked back in time and have determined that the volatility curve has 4 primary formations. There's the rally formation, there's the drawdown formation, there's the end of drawdown formation, and there's the so-called bear market formation. A rally formation is the formation we discussed as we introduced the VIX futures curve. Is usually when the volatility curve is downsloping like this, has a kind of a slight positive slope here, and then it really slopes down on the front end. This, in terms of our indicators, that means that the V delta here is positive. It's above 0.5. The row yield is very positive, is above 5%. The contango is very positive, is also above 5%. The contango row, the difference between VX2 and VX1, is also very positive, above 10%. And the V ratio, the difference between the VXV and the VIX, is also above 1.1. What this picture here tells us is the VIX is far below the mean, and the VIX futures and the VIX spot indices essentially use their normal formula, and they assume that over the long period of time the VIX will go up to 20, but that doesn't mean that VIX will be 20 in 8 months. Again, this is just the normal calculation. But when the volatility curve looks like this, the market is rallying. This is good for XAV. XAV makes a lot of money every day from a positive contango, and the market is melting up and making new highs every week. The second formation is the drawdown formation. So if we have some kind of a sell-off developing, if the market is down for more than a couple of days, what happens, the first thing that happens is people start to panic and they start to buy puts. They start to cover. They don't know what's going on. Why is the market going down? So they start to frantically buy puts, but not so panicky yet. And the VXXT and the short-term indicator especially starts to move up, and the VIX starts to move up as well. At that point, the curve, although still kind of downsloping, it starts to flatten. The V delta starts to roam around 0. The row yield starts to go below 5%, starts to get down to 0. The contango, the difference between the VX1 and VX2, starts to decline below 5% and wants to go down to 0. The contango row becomes again compressed below 10%, and the V ratio becomes smaller than 1.1. So what all of these numbers mean is that the volatility curve is essentially flattening, and we're in the middle of a drawdown. Then as the drawdown reaches its conclusion, its capitulation point, people then really panic. This drawdown has gone on for longer than they thought, and at some point they can't take it anymore, so they really start to buy puts in panic. At that point, the VXST really spikes up, oftentimes above 20. The VIX also spikes up somewhere near 20, while the VX1 and the VX2 futures kind of trail back, but the back end of the curve is still kind of upward sloping, right? And the VXV and the VXMT are somewhat elevated. In that formation, the V delta is now negative, the row yield is now negative, contango is also negative, and contango row is also negative, and V ratio is below 1.0. In this case, the V ratio is positive, but oftentimes it's also below 1.0. the volatility curve in this case gives you what you can kind of, if you have imagination, it looks like a smile. It takes a shape that looks like a smile. So when the volatility curve is smiling at you, that is the time to put money. As we discussed earlier, when the curve goes into backwardation, and backwardation is just this part here, the front part. When the front part goes into backwardation, usually within a week, 75% of the time, the drawdown will end. So when it enters this, when you start to see this smile, you really need to start looking at the long side of the market, and you need to start putting money to work, especially if the market has been in a bull market. It's up trending for a while, it's trading high above all of its averages. Usually when it touches the 50-day moving average is when it undertakes this formation, or maybe undershoots it a little bit, and after that it stabilizes and starts to move up again. And the final formation is the bear market formation. So 75% of the time the market will recover from the volatility curve, and the curve will go quickly back down into a rally formation, and the market will continue its upward trend. But 20% of the time things escalate. The drawdown doesn't end at 5%, it doesn't end at 7%, it continues to go down and gets into correction territory, hits 10% or more. And at that point, the VX60 really spikes up to the 30 level, the VIX spikes up to the 30 level. The VX1, the VX2 future, because they're out in time, now they're starting to say, well, you know, wait a second, the VIX is 20, we really need to discount the spot indices here, so they start to trail the VX60 and the VIX, and then the VX1 is a little bit less, and then the VX2 is even more, and then the rest of the futures curve is down sloping. What that is expressed in terms of our indicators is the V delta is really below -1. Sometimes it can be -2, -3, -4. Raw yield is below -5. Contango is below -5%. Contango is below -10%. V ratio is below 0.9%. V ratio is below 0.9. When the volatility curve is in this formation, in this bear market formation, you really want to stay out of the market. You do not want to be buying the dip. You do not want to be doing anything but shorting the rips in the market. The reason for that is some of these drawdowns, we don't know what's going on. Like in Lehman, you know, a big bank will fall, and then you don't know what is going to happen next. You know, how people don't know what the outcome is going to be from this failure, from this bankruptcy. So people get panicked a lot, and then the market sells off, and people rush to safety, and they sell off indiscriminately. They sell good stocks with bad stocks. They throw the baby out with the bathwater, and you really don't want to be. And this can last for a few months. So you don't want to be catching the falling knife. You don't want to be buying the dip here, because there may not be a dip. You will get a chance to buy the market at some point. The volatility curve will start to flatten again. It will start to. It will take a rally formation, and that will give you plenty of time to buy at low levels, and then ride the wave up. So you don't really, when you're in a bear market formation, you really want to be in cash and just watching the market from the sideline. In addition to the term structure indicators that we discussed I've also created a couple of aggregate indicators that aggregate different parts of the term structure to just give us a better sense of where we are. The first one is the VIX Contango oscillator, which aggregates medium-term volatility expectation. It takes information from the VIX, from the VX1 and the VX2, and the formula is VIX minus 45 times 1,000 times Contango. The 45 here is a factor used to make the VCO oscillate around the zero, and the VCO generally oscillates between minus 100 to 100, with zero being kind of a key value. And it's fairly accurate for market timing, because it takes account of short-term volatility expectations. So if the VCO is above 25, usually the VIX is fairly low and Contango is very positive, and this is a good time to be in the stock market and in XIV. And as you can see, all the periods where the red line here is VCO was above 25. You can see how the XIV had a really nice run. And then when the VCO started to dip into the yellow territory, this was a good time to get out, to sell. And then when it dropped down into the red territory below zero, you can see how a massive drop in the XIV should, and this was also a massive drop in SPX as well. So when the VCO goes below zero for 3 consecutive days, you need to just take everything. You need to take your SPX holding and sell them all. You go to cash. So when the VCO goes below zero for 3 days, you sell everything and you get out of your XIV position, and you don't look back until the VCO. You need to wait for the VCO to finish its downtrend and then turn positive. So oftentimes the VCO, when it goes down, it goes right back up after a couple of days. So you shouldn't really overreact when the VCO hits negative. But if it stays for 3 or more days, this is really bad. This means that volatility is spiking and it's staying high, and that's not a good sign for the market. The next indicator is the VIX term row indicator. The VIX term row indicator aggregates short, medium, and long-term volatility expectations. It takes information from the VX60, the VIX, the VX1, the VX2, and the VXV. And the formula essentially takes the time left to expiration from all of these indicators, and then weighs their value, weighs the premium between all of these values based on the amount of time left to expiration. So it's not as accurate for market timing, for immediate market timing, just like the VCO is, but it gives you a great measure of overall sentiment. It moves along with the VCO, but sometimes it moves ahead of it, or sometimes behind it. But in general, it gives you a great overall sense of what all the different market players think across the different time frames, across the different terms. So if the VTRO becomes positive and the VCO is still kind of negative, what that means is that the market is going to recover. So it hasn't recovered yet, but it will recover soon because people are more sanguine about the future. And likewise, if the VCO is positive and the VTRO goes down to be negative, this is a pretty good indication that people are very worried about the longer term. They're worried about in the short term and in the longer term, and the medium term, while maybe a little bit sanguine, will inevitably follow suit. So it's a good indicator to use alongside with the VCO. So let's recap our term structure indicators. We have the short-term indicators, which are the VX60 and the VIX, and the V delta. Then we have the medium-term indicators. These are 1 month out. These are the VIX, VX1, VX2, Contango, Raw Yield, Contango, and VCO. So they tell us about what people think is going to happen 1 month out. And finally, we have the long-term indicators, which are the VX2 and the VXV, which are the V ratio and the VTRO. So these indicators tell us what the volatility expectations are 3 months out or longer, and that's what I define as long-term. Let's discuss the term structure signals in terms of. So the term structure signals can be simplified with kind of a green, yellow, and red analogy. So green is good for the spine, good for the XIV. When you're green, you need to be long. The yellow is a warning for the spine, for the XIV. So if you come from green level, you need to be selling the spine, the XIV. You need to take precautionary stance selling. And if you come from a red, you need to start buying the spine and buy the XIV when you go from red to yellow. And red is bad for the spine, bad for the XIV. At that point, you need to be either short the SPY, or you definitely should be in cash, and you should not be invested in the SPY nor in XAV, the short volatility ETF. So if you look at these thresholds, when VCO is bigger than 25, Vitro is bigger than 50, Vidauta is bigger than 1, Royal is bigger than 5%, Contango is bigger than 5%, Contango Row is bigger than 10%, V ratio is bigger than 1.1. This is the time to be long the market, to be in the market, to ignore the 1 today dips and just stay long and strong. The yellow is between 0 and 25, 0 and 50, 0 and 1, 0 and 5% for Row Yield, 0 and 5% for Contango, 0 and 10% for Contango Row, and between 1 and 1.1 for V ratio. Again, this is a zone where if you come from green, you need to be selling, and if you come from red and some of the indicators turn yellow, you need to be buying. And finally, the red zone is where everything is negative, and V ratio is less than 1.0. This is an area where, once you enter the yellow territory, you should have gotten out, and by this point you're in cash and you're watching the market and you're waiting for these indicators to turn yellow to buy the SPY back again and to buy XAV, the short volatility ETF again. But these are not the only signals. There's some other volatility signals in use out there, so we cover them on our website, and we also use them, so you need to be aware of them. The first one is the volatility risk premium, then there's volatility momentum, volatility speed, volatility mean reversion, and a current positioning indicator, the put-call ratio. Volatility risk premium is one of the most popular volatility indicators out there, popularized by Tony Cooper. He wrote a paper in 2011 in which he describes how he uses this indicator. But the volatility risk premium is essentially compares historical volatility versus expected volatility. And the formula that he uses in the paper is VIX minus HV10, the historical volatility over a 10-day period. It is the most popular indicator in use out there, and a lot of volatility sites use it to trade the VXX and the XAV with various degrees of success. Essentially, the idea is that if the VRP is positive, you should be short volatility. You should be in a long. You should be long XAV, the short volatility ETF, and when the VRP is negative, you should be long the VXX, or you should be long the volatility ETF. It has some problems. It was really successful for a couple of years, but it hasn't really done all that well since then. So you can use it. It's very popular out there. We keep it on our site for reference. Volatility momentum is when we compare VIX to some kind of a moving average. On our website, we compare it against the 50-day moving average, and we have an indicator called V-force, which is essentially the premium of the VIX over the 50-day moving average. Some people use the 10-day moving average because the VIX has a tendency to spike very fast, and as such, when the V-force goes above 0, usually there is some kind of a spike in progress when volatility starts to move ahead of the moving averages. Essentially, it's in a spike phase, and at some point, it tops out at 40 to 50%. Sometimes it goes up even to 100%. But when it starts to top out, you really need to start to look to get on the long side of the market and start shorting XAV. So when it goes from negative to above 0, you should be buying. You should go long VXX, and then when it starts to top out, you should go long the XAV. Volatility speed is essentially measures volatility of volatility. There is the VVIX provided by the CBOE, which gives you expected volatility of volatility. On our website, we calculate the historical volatility of the VIX itself. We call that VHV, and we have a couple of charts that compare the VVIX against VHV. And the key levels for the VVIX are, if the VVIX starts to spike, usually it's an early indication that the VIX itself is going to start to spike. So if VIX starts to move up and down a lot, there is uncertainty in the market, and usually what that means is the VIX, because of the VIX cycle, when it starts to spike, it usually spikes up a lot, right? So it's usually a very good early indicator that we're going to enter a VIX spike stage, and then when it starts to lay off and it starts to go down, that means that we're getting into the aftershock and the decay phases. And the key levels for the VVIX are 80. Below 80, it means that we're in extreme complacency. If we start to rise up and go above 100, that's we're really getting trouble. And if you go above 120, which doesn't happen very often, we're in the middle of a serious drawdown. And vice versa, when the VVIX starts to decline, it goes from below 120, then crosses 100. This is a good time to start shortening volatility, going long the XAV, and staying in. The other indicator, volatility speed indicator, is VATR, which is the VIX average true range. We calculate VATR for a 5-day period, and the key levels for the VATRs are 3% and 9%. When VATR starts to spike, that means the VIX itself is starting to move up a lot, and that's the time when you want to go long VXX and exit out of any short volatility positions and potentially of the SPY. And then when it goes above 9%, usually you have to start looking out to close your long volatility positions, and when the VATR starts to go below 9%, you need to look to enter short volatility positions and go long the S&P 500. So the VATR is a very good early indicator that when the VIX starts to move less, that's a very good indicator that the VIX is starting to enter an aftershock and a decay phase. So again, the key levels to watch are 3% and 9%. And the volatility speed, essentially, you can think of it as a trend exhaustion indicator. When it hits certain key levels, that means that things have gotten really bad and they're not going to continue for very long. So you can look at it as a trend exhaustion indicator. You need to monitor it carefully. Mean reversion, because the VIX distribution is heavily skewed towards the lower numbers, when you get to be above 30, above 35, you're in the 90th percentile of the VIX distribution. So obviously the VIX doesn't stick around there very long, and during a bull market, if you get a VIX of 25 or VIX 30, that means that this condition is not going to last very long. So at that point, it's a good time to deploy money to go long the SPX, go long the short volatility ETF. It's good to short volatility at that point when you hit these extreme levels, and then as it gets down below certain really extreme level, when the VIX goes below 11, then you need to look to trim your short volatility positions. You may stay in the SPX, but when it hits those levels, some kind of a small drawdown is afoot. The only problem with using this indicator is that sometimes, again, it works 80% of the time, as we discussed. Sometimes the VIX can spike even higher, and that can be a really big problem if you're holding XAV. So usually you have to wait until the values kind of start to decline down before you enter short volatility position or enter the S&P 500. The current positioning indicator is the put-call ratio of the SPX index futures. The put-call ratio is an indicator that's kind of an immediate indicator. It doesn't tell you very much, except for when it hits certain key thresholds, when it trades in an extreme. The key levels are 1.5 and 2.5. As I said, most of the time, pretty much all the time, there's more puts than calls being bought. But when the PCR spikes up above 2.5, goes up to 3 or 4, that means people are buying an extraordinary amount of puts. And what happens in the markets is market makers, they're aware of these indicators as well. And so when they see people buying a lot of puts, when the drawdown is kind of near, is getting to be really heavy, people are panicking and buying a lot of puts, people have positioned themselves the wrong way. So then the market makers, what they want to do is they want to move the price up and render all these puts that were just bought worthless. And that's how the market makers make a lot of money, by rendering majority of the puts and calls out there worthless. So if there is a big condition where the PCR spikes a lot, that's usually a very good early indication that the market is going to start to move in the other direction, to punish the wrong positioning, the wrong immediate positioning of players. Again, this is a trend exhaustion indicator. It is not foolproof. You need to kind of watch it. In my State of Volatility newsletter, I describe it and how it is being used. It's not foolproof. You need to be aware of what's going on at present. So let's summarize all the volatility signals that we have discussed so far. We have direction signals, and then we have trend exhaustion signals. The direction signals are the VCO, the V3O, Contango, Contango, V ratio, V force, and VRP. When those are in green, you want to be short volatility and long the SPX. When those are in the red, you want to be out. You may want to be long volatility for a short period of time. And when they're in a yellow, this is a buy and sell zone. If you're coming from green to yellow, you need to be selling the SPY, and you need to be closing your short volatility positions. And if we go from red to yellow, you need to be buying the SPY, and you need to be opening short volatility position. You need to go long the XIV. And again, you need to look at the trend exhaustion signal. Once they get to be way too green or way too red, usually a turnaround is going to ensue soon after. It's important to understand that there's no silver bullet. You cannot just use the Contango as an indicator. You cannot just use the V ratio. You need to look at the entirety of the volatility curve, and you need to look at all these indicators to gauge a sense of what is going on and what is about to happen. The reason for that is that the different markets oftentimes disagree. As we discussed, there is a SPX options market, there is a VIX futures market, and because they're different markets, they can disagree. So if you think that something is happening, you really need to get confirmation from both markets. You need to monitor all the indicators, and you need to get confirmation from both markets before you deploy money. So in our State of Volatility newsletter, we discuss the state of the volatility curve and all the volatility indicators every week, and we tell you where we are. With this, we're going to end this video.